Okay, so in this video, I'm doing the first part of information system auditing. So if you see, there is 4 parts. So we got part 1, part 2, part 3, part 4. So I'm going to cover everything from part 1 to part 2, right? So everything in part 1. Now, so before you need to delve, or did I just say delve? I mean dive into dive into this. You need to know what's information system auditing. So obviously over here you'll see we just start with auditing first. We don't go into information system auditing. So auditing, just like that, it can mean anything. You can have information system auditing, you can have financial auditing. So auditing, it's basically in terms of information system auditing, which we're going to learn in 2, 3, and 4. It's where you audit the information system of a business. So like if they have a system, an online system, a computer system, you have to audit it to make sure they're complying with laws and regulations, right? Because businesses on information systems, online systems, software, database, whatever has customers' information, they have the ID numbers, cell phone numbers. This is very, very, very crucial that they're complying with like certain acts. For example, the POPIA Act. Is it the POPIA Act? I don't know. POPIA, whatever. But like you have to do an audit, so an auditor has to go and check if they're complying with those laws, right? So let's just dive into part 1, which is auditing. This auditing is just general auditing, so just auditing in general. So let's start with the first page, alright, introduction. So it's definition of an audit, right? Now, an audit, as I told you, is a person, an auditor, who goes and checks if what the business is doing is correct and they report to this person. For example, an audit in a business, right? What they will do is that they'll check the financial statements of a business. So check if everything in the financial statement is correct. They never lie, they never do anything bad. And then after the information system, sorry, not information system, the financial statements is good, they will go and they'll make a report. So there'll be like a page, a report of what they found, if it's qualified and not qualified, meaning if obviously is it successful, the audit, like is it good, or did the auditor find something bad, and they report to the shareholders of the company. So as you know, shareholders are owners of a company. They invest shares in a company, so they buy the company basically. And yeah, the shareholders have nothing about the business. They have no financial information or knowledge, so they hire an auditor. The auditor goes and report back to them on the findings. So that's basically what an auditor is, right? So auditing is a examination of accounting records, right? Carried out in order to establish whether they correctly, completely reflect the transaction present. So always you need to correctly see if what the business did in the financial statement is correct, so they're not lying, right? Roles of an auditor. So an auditor, what's the most important thing? Are assurance givers. So they give assurance that something is true. As for a business as a company, financial statements, you need to make sure that they never lie in the financial statements, right? For example, the profit they made for the year is 1 million, but one owner over there was drinking too much of honey, so he got like mentally I don't know, and instead of 1 million, he put 10 million. So you, an auditor, has to go there and check why on earth is it 10 million when it's supposed to be 1 million. So that's basically it. So it gives assurance. So it gives assurance that the 10 million sales figure or the profit figure is actually 10 million. That's what an auditor does. So auditing concepts. Now, what are auditing concepts? Auditing concepts are like principles of auditing. What is principles of auditing? It's basically things which auditors need to uphold, right? They need to be that, right? So the performance, okay, so these concepts can be grouped into 4 categories, right? The performance of the auditor's work. So obviously, if you're looking at the concept of auditing, the performance of auditor's work is very, very important, right? The auditor has to do good in his work. He can't like miss something in the financial statements that was supposed that's like fraud or something, and he doesn't report on it. No, his work has to be professional. The audit process. So when he checks all the financial statements, he must check it very, very good, right? Communication of an audit outcome reporting is extremely good. If you find something bad with a company, you must share it. If you don't share it, you're breaking the law. The concepts are independence, responsibility, evidence, and reporting. Yeah. So an auditor has a responsibility to be independent, meaning he must be separated by the business. So don't be the owner's friend of the business you're auditing, because then you'll be biased. And obviously, you have to collect evidence and report. You have to collect evidence if you see something wrong with the business, and you have to report on your findings if there's something wrong. Now, the common principles in audits, there's quite a bit, so I'm going to briefly explain. The first one is accountability. Accountability basically means you need to be accountable for something, right? In a business, in a company specifically, auditors are accountable for the interests of stakeholders. Now, stakeholders can be anyone. It can be the business, the owners, the customers, suppliers, anything related to the business. So auditors need to be responsible for all of them or act in the interests of all of them, right? So important, the interests of all of them. So he needs to, in his back of his mind, say that, listen, I have all these people who are relying on me, who hired me. I need to do my work properly to find if the financial statement of the business is true. And if there's something wrong, I need to be accountable for it. I need to tell all the people in the business, the shareholders, the stakeholders, everyone there's something wrong. Integrity. Integrity is honesty basically. So as I said, fairness and truthfulness. You cannot be a friend of the owner. You have to be truthful. If there's something wrong with financial statements, be truthful, right? Fairness and truthfulness also like implies that you must be faithful. Do not like do something bad. Like do not get bribes and stuff from the owner if there's something wrong with the financial statement, so you don't report on it bad. You have to report what you find. You have to be fair. You have to be responsible. Objectivity and interdependence. Objectivity basically means independence. So it basically means you have to be independent of the business. So as I told you, you cannot have any relation with the business, right? When you're conducting an audit, you have to act independent. So the owner can't come talk to you and say that, listen, I know I lied in my financial statements. Just don't tell anyone. That's not thing, right? You're going to be breaking this principle. Competence. So competence basically means that you have to be good in what you do. So do not buy your degree. So competence basically means you have to be a good auditor. So your auditor skills has to be good. Riga, Raija, oh, is that stutter? I don't know. I feel like that's stutter. Wait, does that how you pronounce stutter? Raija. I don't know, but it doesn't matter at this point. Whatever this is, Raija, Tara, but I feel like it's Tara because it's saying here basically all your information, what you do in your audit, it has to like you have to like work with it thoroughly, right? You have to work with it properly. So if you find things that are wrong, you have to look in the books of the business. You have to go very, very deep and find all the evidence or everything. You basically have to work very, very thoroughly, very, very strongly, and you have to be like a real auditor. So yeah, so you have to act critically, right? Very good work, critically. You have to go in the business, right? Be a detective, go in, find stuff. Judgment. Now, judgment of an auditor is very, very crucial, right? The judgment of the auditor plays a very crucial role because if the auditor says this business is bad, it's going to affect the public, everyone. The company is going to go down, stock market is going to crash, literally. So the judgment of an auditor has to be professional, right? If the financial statements are good, he has to say it's good. If it's bad, he has to be bad. His judgment is very, very important, right? It affects the business, so he has to act on very, very good judgment, right? Clear communication. Now, an auditor needs to be very, very clear in communication. So if you want to become an auditor, if you never get more than 50% in the English paper 3, don't become an auditor. So basically, that by the way, that will be me. But yeah, basically communication, right? So you have to communicate in your findings when you do an audit of everything that you saw when you were analyzing the business financial statements, right? Whether it was good, whether it's bad, you have to have clear communication. If you found a problem with the business, let's say the owner, um, basically the sales was 1 million, he basically put 10 million as sales. You can't just say in your report that, listen, it's supposed to be 1 million, but he put 10 million. you have to be clear, how on earth did he do it? Did man make a printing mistake? Did man was looking at too many zeros and put another zero? You have to basically try and understand and communicate to whatever person you are why on earth that man did an extra zero. Wait, 1 million and then 10 million, that's not an extra zero. 1 million, there's 6 zeros, if I'm not mistaken. And then 10 million, is it 7 zeros? 10 million. I think so, it's just 7 zeros, I don't know. Association. So, association is very important. Association basically means, so you know the report the auditor gives. Let's say it's a very, very good report the auditor gives, right? Holding that report in your hand or in the public image, it's very, very good, right? But let's say a business does this, right? A business uses this auditor's report that's very, very good to put information that's bad together. Now, hold on. What are you saying? So let's say you're a business and you a popcorn business, huh? So basically you make popcorn, and your popcorn, it's coming from a not very, very good source. So the cornfields that you're getting the popcorn from, it's not real corn. So it's a big company, Chinese company, basically taking all the people who went to dentists their rotten teeth, and they're basically making popcorn. So now, when you're advertising this business, you will basically say this is a very, very good, best popcorn on earth and all that. Then you take the audit report that was for the business for the financial year that you did good business with, basically, and accompany it with that popcorn. Advertising, why I can't say proper English. I can't become an auditor. Advertisement, right? So this audit report is good. This advertisement, you know it's going to be bad. But the business owner will put it there so it can make his business look good. That's bad. So basically, in summary, you can't put stuff that is bad with the audit report that you got from the auditor, right? Association. I hope I made myself clear on the scenario. I don't know why I went in that route, but yeah. Imagine the teeth. Providing providing value. So whatever you do in your report has to provide value as an auditor, right? So when you do your reporting to the directors and everyone, you have to make sure that you provide value, right? You report reliability and validity. So you have to be reliable, that you got the information, has to be honest that the information is correct, and you do that information holds value to the company. Because an auditor's information to report is very valuable in the eyes of the public, right, to the shareholders, right? You will know that if a bad article comes out or something bad from an auditor's report comes out, market price goes shoo down, down. Everyone sells their shares, market crashes, yeah, all that nonsense. Reasons for need an auditor. Now, what are the reasons you need an auditor? So, an auditor, you might need it because changing with new regulations. So remember, when you own a company or a business, you need to understand, you need to be in law. So you need to be within the laws of the earth, right? The earth laws are keep on changing, right? One day they want you to manufacture fish. The next day they might want manufacture another fish. I mean, there's a law that says you can catch how many fish or whatever. But basically, what I'm trying to say is laws keep on changing for the business. An owner cannot just look at the laws every single day. He has his own things in the business. So when you had an auditor, you can get the auditor to do that work. So check all the laws, make sure every law is being withheld or being followed in the business. Huh? There's different acts, health acts. So there's just too many acts, too many laws getting updated between those acts. So an auditor will go in the business, make sure all the acts are being followed. If it's not, it'll tell the business, and all those new acts and laws will be regulated done in the business, right? Sound business aims at luck in sophistication. Knowing me, when I saw this word, sophistication, I genuinely do not know what it is, but basically I use ChatGPT, as always, ChatGPT, master of the integrity. Sophistication basically means upgradation. Wait, there's not even a word upgradation. Upgradation. Sophistication basically means as Earth revolves. I'm making this so complicated. Sophistication basically means when things are changing, right? Things are changing, always things are changing. So when things are changing, the business aims to lack in sophistication. So when everything, the environment is changing, businesses want to be the same, so they don't upgrade. For example, yeah, in this whole thing they discuss about errors. So once upon a time there was a business, right? And computers were not that sophisticated, it wasn't that of high level, it was very very simple computers, right? So what this all does is very very simple, right? To make money fraud in the code for the business when they're doing transactions, they will basically corrupt the code so it gives them a couple cents for every single product they sold, and later on all this money is sent to their bank account, and that's fraud, right? But then the auditors, basically they viewed this and looked at it. As computers got more and more intelligent, so more sophisticated, this actually they couldn't do it right, because it was very very hard to do, because programming languages got more intelligent and so on. But now auditors, they basically seen that is a new problem, that people are breaking into information systems, right? So basically, the programming relied in some measure of computer controls. Yeah. So computer system controls got now very important, because as computer programs sophisticated, now everything is stored on computers. People in the whole company, the world is being stored on computers, information systems. So now they need to basically have auditing in place in computer systems. The split between ownership and management, right? So if you imagine a company, the owners are the shareholders, the management are like the directors and all in the business, right? At the end of the day, the ownership, the people who own the companies, they don't control the company, meaning they don't like work in the companies. If you're a shareholder, you're the owner of the business technically, but you cannot work in the company. So that is why you need an auditor, because when you're an owner, you do not necessarily mean you work in the company, so you can't make sure everything going well in the company. Therefore, hire an auditor to check if the management is doing everything correct. So yeah. So owners' money, because they invest in the business, right? So they need to make sure the business is doing everything honesty and stuff. So how they do it? Hire an auditor, make them audit the whole company, give a report to the owners back to see if they're doing well. Um, Confidence of business information system and finances. Yeah. So in audit, the reason you need to provide confidence, right? So your shareholders, you need to provide confidence to them that, listen, we're doing everything well. So you do an audit. If the audit comes back good, that's very good. Provide confidence. Provide assurance and credibility. Provides assurance that everything we're doing is good. So it enables the government to collect tax fairly. So it makes sense, right? The profit of the business, the higher the profit, the more tax. The less profit, the less tax. More depreciation, the less tax. So all those figures in a financial statement have to be represented fairly, because it affects how much tax the business gets. Because some do people businesses do tax evasion. See that is why they need audits. So inspire confidence, develop economy as a whole. So as I said, the more tax, the better for the economy. Direct individual investors, yeah. So all investors, shareholders, whatsoever, right? Accountability. Now, accountability. I told you, you need to be accountable for what you do. If you do something bad, you need to be accountable for it. Now, they give this whole table, but it's a very simple table if you think about it logically, besides like actually thinking about it. So the owner, he is responsible of providing risk equity. Risk equity is the money the investors invest in the business. It's a share. When you buy a share, that's you're providing risk equity. The reason risk equity, you might buy a share in a business, but the following year the business goes bankrupt and they can't pay you. So this owner is accountable to vote. Now, if you own shares in a company, there's something called an AGM, yeah, and something annual meeting or something. So basically, all the shareholders can vote of the new director of the business and so on. So they're accountable to vote. So basically, like they must vote. Board of directors. Now, the board of directors is hired by the owners. When they vote, right, they vote for the directors. The responsibility. So this role is responsibility is hiring management. So management is all these people below. They're like people like the managers, the employees, and so on. Sorry, not employees, the managers. And they are accountable to the owners. So obviously, because the owners, which are the shareholders, hired the directors, they have to be accountable, tell all the stuff, the business, what's happening to the owners. Now the CEO basically manages decisions of a business. It's basically very high level. So it's responsible for the operational, okay, and is responsible for both the owners and the board of directors. Now the management, he is also considered responsible for operational, but he reports to the CEO and board of directors, right? So there's two people on top, right? Employees, obviously, they're going to be accountable to the management only, and they're responsible to adhere to policy and customer service. They provide customer service. Creditors, the people who you owe money to, they're responsible to maintenance of the organizational debts. So they are responsible to keep a record of how much the money is owing, and they obviously are accountable to management, board of directors, shareholders, and everyone, right? Because they need to report how much they owe to them. Suppliers, sorry, how much the business owes to them. Suppliers, they obviously are responsible for operations in the business. Obviously, supplies is the goods, so they're responsible to providing goods to operations. They're responsible to the management of the business. Customers, they're responsible for profits. I mean, obviously, they're responsible to making a business profitable, and they are accountable to the government. So that means in taxes. It makes sense because when you buy from a business, if there's a VAT vendor, they pay VAT, so they're responsible for providing VAT. Government, they are responsible to provide all the laws to society and so on, and they are accountable to the constitutions. So these are basically they in charge of the government. So government is to report back to them. Policies, standards, guidelines, and procedures. So very easy. Policies are basically like it's like a one-page document, very less, right? They make the points. They're the highest point ranking, like basically like laws. Like policies are high, standards are second high, guidelines are third high, procedures are fourth high. So the first high policies are high-level documents signed by a person of significant authority. For example, if you look at a company, what would be a policy? Be honest. Literally, be honest could be a policy. Now, a standard falls under a policy. They're mid-level documents, right? It's the application of the policies. So a standard for so remember the policy I said is be honest. So in your standard will basically say all financial statements need to be reported with like IAS 16. So IAS 16, it's a standard in accounting where you need to report all the assets of your business, like your vehicles and so on. So reporting all this finance, vehicles and whatnot in according to IAS 16 provides honesty, which is your policy. Your policy is to be honest. So doing a standard like IAS 16 helps you to be honest. So also in IAS, so also a standard could be, I don't know, report all information on financial statements fairly. So doing that does the honesty as a whole. Guidelines is when standards there's no standards, right? So when there's no standards, it's basically you providing guidelines. For example, guidelines: employees must not basically mustn't like play with their phones during work time. That's going to be a guideline. There's no standard, like there's no rule. Oh, employees must not play with their phone during work time. You cannot make that rule. So that's are called guidelines. That's a little bit less than all these policy standards. Procedures are steps to do a standard. So if you look standards in accounting, if you do accounting, for example, IAS 1. So it describes all the financial statements, how they must be represented, and so on. That law, IAS 1, has procedures. So how do you maintain that law? So you have to put all your expenses in your income statement. You have to account for depreciation. So basically, all the steps you need to do a standard. That's basically it, right? Auditing theory. Now, auditing theory is everything in auditing. So there's a whole thing over here about saying that. Okay, so in auditing theory, basically everything in auditing, right? So obviously, all this in auditing is very hard to understand. There's all these laws, these regulations, and it's so confusing to teach it to people. So this auditing theory is developed to explain the practices and principles. So auditing theory puts auditing very, very easy to explain it to people, right? To explain the practice of accounting to their students. So auditing theory is basically a set of theory. So basically, if you picture a textbook of what auditing is about, all its procedures and so on, that's auditing theory. Now, assumptions of auditing. There's a lot of assumptions of auditing, but it's simple. Assumption one. Now, you might think, what is assumption? An assumption is what you assume someone must do or how they do it. What is an assumption of a student? They get a degree, they study, they work hard. That's an assumption. If that assumption is not met at first, which I say over here, if these assumptions do not hold, the model fails. So if assumption you don't like, it doesn't hold, like it doesn't work. For example, an assumption of a student is to get a degree. If you do not want a degree, then that contradicts the assumption, right? So same with an auditor, they have assumptions. There is a need for an audit. That's an assumption. If there was no need for an audit, you don't hire an auditor. So you get what I'm trying to say. There's a need for an audit. So assumption one is a need for an audit. So when you hire an auditor, you obviously have there has to be a need for an audit, right? So there's an imposed audit. What is an imposed audit? It's a compulsory audit. So it means that the business has to be audited no matter what, according to an act, a law, a regulation, and so on. Right? We're going to discuss all these regulations in the next things. Assumption two, the subject matter is too remote. You might be asking, what does remote means? So let's say a remote means you can't get to the business. For example, the shareholders of a business, they're the owners. They can't physically go in the business and check all the stuff, what they're doing is correct in the business. The business is remote to them, maybe different countries and so on, right? Too complex. Again, shareholders, they don't have necessarily the skills to audit financial statements and so on. You need to do it by skills profession. So that's a auditor. Too important without an audit. So financial statements in a business is very, very important. That is what it needs an audit. So it's very, very important, right? Assumption three, an audit must be conducted independently without constraints. So basically, they must be conducted without someone, like it mustn't be biased, right? So without bias or prejudice. So you have to report your findings, be honest, and so on with the people, because do not like mislead people, do bribes and so on. The subject matter of the audit can be verified by evidence. So do not start an audit. There's no need for an audit if there's no evidence. If you're going to do an audit of a financial statements, there need to be evidence backing up the financial statement, right? So obviously, a financial statement is just a statement, but obviously in that statement, you in the background they might have ledgers of the company and so on, computer system, how they got to the answers in the financial statement. So there needs to be evidence, so the auditors can check the evidence and make sure everything is good. The purpose of the audit is to specify clear the results communicated clearly. Um, hmm. The purpose information. Okay, so basically what they mean is this. So the financial statements, if it's messed up already, there's no need for an audit, right? You do an audit to add value to already good information system. Information. So if the data or information the auditor is auditing, if that's not communicated clearly, if that's not good information, do not do an audit on it, right? An audit produces an economic or social benefit. So the benefit could be to the shareholders, that's social benefit. It provides benefit to the people and so on. Obviously, that's what an auditor should do, provide benefit to people. Very, very important types of audit. Internal auditors. So if you own a company, you need an internal auditor. So an internal auditor can be like an accountant. So they look at all the security measures in the business, control, make sure there's no fraud, check all the systems are good in the business. So internal. External, however, they are hired by the shareholders of the business, right? So they have absolutely no interaction with the business at all. An external auditor is from Joburg. He goes and audits a company in Cape Town. Completely outer person from the business. He will verify the work of the internal auditor as well as the business as a whole. So he will sit with all the financial statements on his desk with coffee, and he will audit the financial statements, look at all the work the internal auditor did, and verify if he's correct also. Because internal auditor could be making his own numbers too in the financial statements. Government audits. So government needs to be audited, right? Because governments sometimes they steal money and they mislead the people. So they need to be audited also. Forensic auditors. So let's say in a business there's fraud. So big fraud happened. You need to basically hire a detective. That detective is actually called a forensic audits. So they look at how the money was stolen, where the money was stolen, all those. Basically a detective in finance. Environmental audits. To see how well a company is doing environmentally. So how much pollution are they? If the pollution levels are 15.22 and the company is doing 18.22, that's bad. They need to be fined. So an audit will make sure that they producing like toxic gas less than that measurement. Information system audits, which will be number 2, everything below, are basically all the audits you need to do in your computer system to make sure you're doing laws. If the POPIA Act or POPIA, I don't know what act that is, all keeping all customers' information securely, not leaking the information, you need to make sure an auditor, the system is doing that. You need to go to the system, check the listener, is that system doing everything correctly? Is there any like ways in which the system can be breached? The system could be hacked. You as an auditor need to check that information system, which will be everything in 2 and so on. And that's the video on part 1 on information system auditing. Just mind my pronunciation, and yeah, that should be good.